Wanted to share with you how we helped some clients this week save just under $75,000 tax on the sale of their investment property. These clients were in their early 60s. However, this strategy can work no matter what age you are if you have an investment property that has a capital gain and you want to reduce the tax payable on the sale. So in this example, these clients purchased this property about 15 years ago and the cost price for the property was $1.2 million. They've subsequently just recently sold that property for $2 million, giving them an $800,000 capital gain. Now they own the property together or jointly, so that gain will be split between the two of them. But before it gets split between the two of them, because they've owned the property for longer than 12 months, the gain will be halved. So they go from $800,000 down to $400,000 as the assessable capital gain that will then flow through to them individually at $200,000 each. And I'll give you a bit more detail around how we've been able to save them on tax payable. So in this financial year, Mr. Client, he will earn $70,000 from employment and Mrs. Client will earn $40,000 from employment. So their total taxable income, when you add the $200,000 capital gain, for Mr. Client, it'll be $270,000, and for Mrs. Client, that will be for $240,000. So what we got them to do was to download from their ATO portal a report that told them that they had some space in their concessional contributions because they haven't been making full concessional contributions to superannuation over the last 5 years. This report is known as the carry forward concessional contributions, and you can download your own to take a look. So for these clients, the numbers for them that were available was for Mr. Client, he had $120,000 that he could contribute to superannuation under that carry forward rule. And for Mrs. Client, she was able to contribute $125,000 to superannuation. So what were the tax results? Let's focus on Mr. Client first. If he wasn't to contribute to superannuation, his tax bill this year would have been $97,500. So subsequently, by making the contribution to superannuation of $120,000, he was able to reduce his assessable income down. And by reducing his assessable income down, that meant that his tax bill for this year in his tax return was going to be approximately $40,000 in round numbers. What we do need to also note that is when he makes the contribution to superannuation, he will pay tax when that money goes into superannuation, and the tax rate on that is 15%. And that tax bill in superannuation will be $18,000. So now his total tax bill payable for the year is $58,000. Versus paying $97,000 or $97,500 if we hadn't put this strategy in place. For Mrs. Client, the results were reasonably similar. So we put the $125,000 into superannuation, which brought down her assessable income for the year. That reduced her tax payable from $81,000 down to $27,000 in her tax return. But like Mr. Client, we also need to recognise that she will pay some tax on her way into superannuation, and that tax bill would be $19,000. So the total tax payable with our strategy now is $46,000 versus an original tax bill of $81,000. So as mentioned earlier, these clients combined have saved just under $75,000 in tax through this strategy. For Mr. Client, it was nearly $40,000, and for Mrs. Client, it was $35,000. So if you're looking at selling a property and you have a capital gain on it, first thing to do is to jump into your tax portal or ask your accountant to provide you with this information and get access to your carry forward concessional contributions report. Look, if this strategy sounds like something I can help you with, or if you'd like to workshop this, please give me a call and book in a chat, and I'm happy to work through your scenario with you.